Hey, everybody. Thank you for watching another update. This is for the month of September. So, monthly recap for September. It was, I say it every single time. It was a busy month. This was especially a busy month, though, because we finally got the Fed meeting. And as everybody knows by now, the Fed cut rates 0.5%. So, we're going to be talking about what data came out that kind of led up to that Fed meeting, the Fed meeting itself. What's the Fed now predicting in terms of the Fed funds rate, unemployment, inflation, GDP, lots of different things to get into. And then mortgage rates as a whole continue their basically 5-month run of decreasing. Mortgage rates improved to about 6.125% today for a first-time home buyer making less than 120% of the area median, kind of the ideal scenario. But yeah, that is kind of what we're going to be getting into. September, Labor Day, it's kind of a holiday that we take for granted, but they literally used to throw parades for Labor Day, which actually makes a lot of sense. If you were forced to work 12, 14 hours a day, you'd probably throw a parade if they cut your hours down to 8. So there's that. And then official beginning of fall. Love fall in Colorado. It doesn't last long enough, but it's such a beautiful time of year. So yeah, let's get into it. So I want to revisit real fast with our Hawks and our Dubs. I've kind of put them aside and I haven't really been focusing on them too much, but it's worth kind of having one last kind of recap on this because of what's going on with the Fed. So as you know, Dubs want to cut rates, right? They are financially accommodative. They want to reduce rates, okay? Hawks, they focus on keeping rates elevated or even hiking rates to really keep inflation in check. So their Hawks prioritization is we want to focus on keeping inflation low. Dubs is we want to continue to focus on having the most financially accommodative environment for businesses, for individuals, the maximizing employment, minimizing unemployment. Their focus is on that to basically the downside of inflation. Hawks see it just the opposite way. We need to focus on inflation above all else. So if you recall, Hawks and Dubs, they've been playing a game of tug-a-war, right? And the rope, if you recall, is made up of the dual mandate that the Fed has. The Fed's job is to minimize unemployment, maximize employment, okay, as well as keep inflation in check. That's what the Fed's focused on. That's their dual mandate. This rope that they're playing tug of war over is that dual mandate. So let's take a look real fast at what's going on with unemployment and then inflation, and then we'll get into the actual Fed meeting itself. So unemployment, BLS has had a rough go of it. I poked fun at them last month saying, what is it that you do here? Because they came out and admitted that they were off on their numbers by like 28%. It was like huge swing and a miss. Anyways, the BLS has been struggling a little bit, Bureau of Labor Statistics. In August, unemployment increased from 4.1% to 4.3%. If you recall, that was a big surprise to the markets. The markets weren't sure what to do. It caused a lot of volatility in the markets. It was kind of a really big surprise. Well, last month, unemployment decreased. So the headline was, hey, look, unemployment decreased. Everybody can take a chill pill, relax. Everything's going fine. Don't worry about it. But if you really looked into the numbers, what you saw was unemployment decreasing for the wrong reason. Okay, so there was only 142,000 jobs created in that report. The economy added more part-time jobs, but they lost full-time jobs. So yes, they gained jobs, but they gained the wrong types of jobs. That's not to say part-time jobs are wrong, but when people are looking for full-time employment and all they can do is find part-time employment, that's wrong, right? So the economy actually picked up jobs, but the jobs they picked up were part-time jobs, not full-time jobs. They actually lost more full-time jobs, but they gained more part-time jobs than they lost full-time. Kind of weird, but that's exactly what happened. Corporate layoffs were kind of off the charts a little bit. It was a really bad month for corporate layoffs. Those are up almost 76,000. The prior month for like kind of a more typical month was like right around 26,000. So pretty significant increase there. And then job openings year over year are down 12.5%. So, point of this is if you just look at the headline, you'd see unemployment decrease 4.3 to 4.2%. Everything's getting under control and fine. But if you really dived into the numbers, you'd be like, oh no, that is not a great report. Headline looks great. The actual data does not look great. Okay, set that aside real fast. We'll be revisiting unemployment here in a second. So inflation data, kind of another tale of two sides, right? If you just looked at the headline, which is all in inflation, okay? So headline is all in inflation, okay? It includes energy prices and cost of food, all in. Okay, then there's the core rate. The core rate takes those volatile food and energy components, they remove it from the calculation, and then they do the calculation. Well, you're going to find, as you look at these numbers, there's a big difference between the headline and the core. And there's one real reason for this. So there's producer price index, consumer price index, and personal consumption expenditures. PPI, producer price index, measures inflation on the wholesale level as businesses feel it. Consumer price index and personal consumption expenditures, two different ways to figure out how us consumers feel inflation. Okay, so consumer price index, CPI, and PCE, personal consumption expenditures, are probably a little bit more relevant for us. But anyways, producer price index, the headline decreased from 2.1 to 1.7. Woof, big change. Headline decreased on consumer price index, 2.9 to 2.5. Another huge change. Personal consumption expenditures, it decreased 0.3% to 2.2%. Like, headline figures all over the map, really, really good. But it had to do with energy prices, and almost exclusively energy prices. When you remove that volatile food and energy components, you actually get a little bit of a stubborn inflation picture. Core increased from 2.3 to 2.4%. On CPI, it remained at 3.2%. And then on personal consumption expenditures, it increased slightly to 2.7%. That really was more of a rounding. They had rounded down to 2.6, and now they're rounding up to 2.7. So again, a very small change. But again, increased on the core, and the core is more relevant for us, right? Volatile food and energy components, like, you don't want to have your inflation calculations be completely dependent on, energy prices spiking 1 month, or again, the cost of eggs or chicken going up, right? So they remove those volatile food and energy components, and the core rate is really what they focus on. The government ultimately wants core PCE to get down to 2%. More on that in a little bit here as well. They also want core consumer price index to also get down to 2. So got some ways to go there. It's going to be a little bit of a longer haul. So we have our hawks and our doves playing tug-a-war, right? Well, how's that looking? Well, as you can tell, the green is in favor of the doves. The red figure is in favor of the hawks. So the doves have been dominating this game of tug-of-war. Kudos to the doves. That's not easy to do. But the doves have been dominating this. Inflation has been cooling. Employment has been weakening. That's good news for doves. That means doves are going to control more of the volume in that room, the room of the Fed. The red numbers, again, we got some stubborn inflation data, but we got some really kind of weak employment numbers. And I think the weakening employment numbers were worse than the stubborn inflation figures. So the Fed meeting. I've been highlighting September 18th meeting for a long time, literally months now. I go back a few recordings, and I was like, a few months of recordings, and I was like, we're circling September 18th. That's going to be a big day. And sure enough, it was. We kind of saw that coming. First of all, the Fed didn't cut rates on July 31st. Second of all, any date with an asterisk next to it is a meeting with a summary of economic projections. That's where the Fed shows their work and has to explain where are they going from here. The insight was, the guessing was, hey, look, if the Fed is going to initiate that cycling of lowering rates, it's probably going to coincide with a meeting of a summary of economic projections where they can actually explain what they're doing, not just do it, but actually show their work. Here's what we're doing, and here's why we're doing it. Sure enough, September 18th, no surprise, the Fed cut rates. The only real surprise was it's going to be 0.5% or 0.25%. Okay. Right after the meeting wrapped up on Wednesday, September 18th, Jerome Powell came out and he said a couple things that were pretty important. Number one, 0.5% is not the cadence the market should get used to. Okay, that's really important. He also said that the market should expect the Fed to continue to remove restrictions. What does remove restrictions mean? That's simply Fed talk for, hey, there's more Fed rate cuts on the way. Okay, this is one of many. Now, where does the Fed actually think we're going to go from here? So, as you all know, Fed cut rates 0.5%. That directly and immediately impacts short-term rates. Credit card rates, personal loan rates, savings deposit rates, immediately directly impacts those. Okay, home equity lines of credit is another one. It does not directly impact long-term mortgage rates. In fact, mortgage rates have actually decreased 1% over the last 5 months in anticipation of the Fed rate meeting on September 18th. Since September 18th, rates have actually slightly gotten worse. A lot of that is because people have been taking their money out of those safer investments and put it into the stock market, which is why the stock market's hitting like all-time high after all-time high right now. That money has to come from somewhere. It could have come from under a mattress, or it could have come from a safer investment asset like mortgage-backed securities, right? So that's part of what's going on. But we did see rate improvements. We just saw it in advance of the Fed rate meeting. Fed was very clear with what they were planning on doing. Only real question was it going to be 0.25% or 0.5%? That was kind of the only real question mark going in. Right before the Fed wrapped up their meeting, there was some leaks going on that said, hey, look, it's probably going to be 0.5%. It's probably going to be 0.5%. But going in, it was basically a coin flip, 0.25% or 0.5%. That tells me when the Fed cuts rates 0.5%, that they looked at the data of that unemployment report instead of looking at just the headline. The headline again saw a decrease in on the unemployment figures, but all the data did not really support such a rosy picture. That tells me the Fed looked at that and they were a little bit more concerned about that. And I'm going to look at a couple pictures here in a second. It's going to kind of paint that picture really clearly. So the majority opinion is each one of these dots is one Fed member's opinion. So 2 members are expecting no Fed rate cuts. The Fed rate currently stands in a range of 4.75 to 5%. Okay, so there's 2 members thinking, hey, we're not going to see any more cuts. But the vast majority of the opinions, we're going to see either 0.25%, which are these members, or 0.5%. And then there's one outlier that thinks we're going to see 0.75%. Okay, so about 0.5% additional cuts in 2024. Well, the Fed says 5.5% is not the cadence the market should get used to, and there's only 2 meetings left. That would tell us that, hey, we're probably going to see a 0.25% cut in November and another 0.25% in December. Reading between the lines here, a lot can change. There's going to be a lot of data, but that makes a lot of sense, right? The Fed says, hey, don't get used to 0.5%. There's 2 meetings left, and the majority opinion is, hey, look, we're going to see 0.5% cuts. Makes a lot of sense. So likely going to see a 0.25% cut in November, a 0.25% cut in December. Then there's an additional 1 to 1.25% estimated in 2025, and another 0.5% estimated in 2026. So this is just the beginning of many. Okay, rates are going to continue to move down. It's the beginning of a series, a cycle of rate cuts. So get used to it. It's only going to be good news from here. Hopefully, knock on wood, because gosh knows consumers need some relief. Let's talk about unemployment here. Fed recognizing that it's going to get worse before it gets better. Okay, so the unemployment rate is currently at 4.2%. These blue boxes here represent the current Fed projections as of their September meeting. So they're projecting it's not going to get any better this year. If anything, it might actually get a little bit worse. What's really interesting here is this dotted line is the June projection. So the last time they had this summary of economic projections, what were they thinking? Wow, they were way more optimistic on the unemployment front than they are right now. That's amazing how quickly things change. They were all saying, yeah, unemployment's great. Don't worry about it. We're fine. And then BLS comes out with some really soft numbers and also a huge revision. And then all of a sudden, the Fed members are like, oh, yeah, no, this is this is going to get a little bit worse before it gets better. In 2025, 2 members are thinking it's going to get worse. 2 members are thinking it's going to get better. But they're all of the opinion that unemployment is going to be in a range between 4.2% and 4.7% next year. So they're also admitting, like, yeah, it's not going to be a great year for unemployment. They do think it's going to get worse before it gets better, generally speaking. They're not thinking that things are really going to start moderating until 2026. Now, 4.7% is still not, outrageous, but it's worth keeping an eye on. Inflation. Fed is recognizing that it's going to take some time to get back to their 2% target. Now, they're actually happier with where inflation is currently relative to where they were back in June. In June, they were thinking it was going to be hotter for the rest of the year. In June, they thought it was going to be hotter next year as well. They're now a little bit more optimistic now. They're thinking, hey, look, currently it's at 2.7% for that core PCE. They're thinking it's going to be in that range of 2.5 to 2.8% next year, 2.1 to 2.2% in 2025, and then 2026 is when they're going to get to that desired level. That's important as well. The Fed is acknowledging, hey, look, we know it's going to take some time to get to our inflation target, and we are okay with that. We're still planning on cutting rates. It's not going to stop us from doing that. We're more concerned about unemployment than we are concerned about inflation. Okay, so I like that the Fed is being a little bit more realistic. The Fed is admitting that, hey, look, we're not going to see their target level of 2% core PCE next year. We're probably going to not see that until 2026. Obviously, these numbers will change quite a bit. We're going to get an updated estimate before the end of the year as well. So there's that. GDP, there was the most consensus around GDP. They're basically all thinking it's going to be around this 2% target for the foreseeable future. They have no way of knowing. It is worth pointing out that they do not expect a recession. Okay, so the Fed is really hoping to have that soft landing, right? We had a whole bunch of rate hikes. Now we're going to start to cut rates. Can we do so in a way that prevents a recession? That would be a soft landing. they've kind of admitted that, hey, it's going to be a little bit of a turbulent approach between inflation being a little bit stubborn, unemployment going to be worse than they originally expected, inflation taking longer to get to where they want it to, but they still think that there's going to be a soft landing. It's just going to be a little bit turbulent on the approach to that, to that soft landing. That's what the Fed's currently predicting. Finally, looking ahead. So like I said, it was a busy month. This month is going to be a little bit less chaotic. We are going to get ADP employment reports on Wednesday, BLS reports on Friday. So there's that right around the corner. You'll get that information out on Friday when I do my weekly market update. Updated inflation data, as always, going to be pretty relevant here. And then there's no Fed meeting. And since there's no Fed meeting, the technical analysis and the fundamentals are going to be in charge. Okay, so technical analysis is, hey, how's the bond market doing? Where are the floors of support? Where are the lines of regression? Is there ceilings of resistance? How are stocks doing? Because stocks and bonds tend to go in opposite directions. So yeah, technical analysis, fundamentals are going to kind of dominate. Hopefully we can kind of get back to normalcy after this kind of crazy month that was September. So that is it. I hope you all have a wonderful month. Thank you all, as always, for the referrals. It means quite literally everything to me and my team and our business. We live and breathe and die because of it. So thank you so much. And if you have any questions or feedback, let us know. Always take into consideration. I've heard from all of you, so thank you so much. But please keep it coming. If there's something else you want to hear about, let us know. And yeah, thank you all so much. Have a great day. Have a great month. See you next time.